G'day, thank you for joining us for the Firetrail Q1 update. Today with us we have Blake Henricks, Portfolio Manager and Deputy MD at Firetrail. Blake, thanks for joining us. The first quarter in the Australian equity market was a really big one. We had the February reporting season, but we also saw a huge shift in performance from the December quarter in the prior year. How did the portfolio perform during this time?
Yeah, well, you're absolutely right. I mean, the market in the March quarter was extremely strong. I mean, it felt like it went up every single day. That didn't actually happen. But if you look at, the December quarter, markets fell around 10%. March quarter up around 11%. So it can be put down to the Fed. The Fed went on pause, and volatility collapsed. So I counted the number of days that were plus or minus 1%. There were just 6 in the March quarter. There were 20 in the December quarter. In terms of how the portfolio fared, we almost kept pace with the market. We were down about 1% less than the market. So market up 11, we were up around 10.
Great. And what were some of the key contributors to performance during that quarter?
Yeah, there were probably 3 key contributors, Worley Parsons, Rio Tinto, and also A2 Milk. Now, if we look at Rio Tinto, they've clearly benefited from what is an absolute tragedy, which is the Brumadinho tailings dam collapse in Brazil. If you want some sobering reading, I'd encourage you to read the Vale transcript on the 28th of March. We can send that to you if you like. But, this is a real tragedy. And there are some pretty real parallels between what happened with the Fukushima disaster, we believe, in Japan, where after the nuclear meltdown, you saw a huge shift towards LNG, away from nuclear, and that went on for many, many years. And so we actually believe that supply of iron ore will be constrained, and that's going to be pretty positive for a company like Rio Tinto going forward as well. Worley Parsons also contributed strongly. It had a really poor December quarter as the oil price collapsed, but they delivered a really good result. The revenues were up 11%, profit was up more than 20%, and that's all we want of them. And so we're seeing continued execution in terms of cost, and just staying focused on what they're good at, which is all we ask. Finally, A2 Milk delivered a really good result as well. That revenue growth in line to probably slightly better than expectations, but in particular the margins were very strong. And so they're executing in Australia, they're executing in China, and they're also making some really strong gains in the US. And we think there's some more things they're doing out there which will create more shareholder value over time.
Great. And we were talking about February reporting season. It's a great time to test thesis and see the earnings there. Was there anything that came through that surprised you?
Yeah, so there definitely were. There's always surprises in reporting season. Woolworths, which is one of our larger positions, it was a disappointing result, absolutely. Supermarkets, which is 70% of earnings, did miss expectations, and also in liquor they've had a few problems with Dan Murphy's and some format changes there. But if we just stick to supermarkets, because it is 70% of earnings, we and the market underestimated the impact of Little Shop and the ban on plastic bags. Now, we saw what happened to the sales line, but what it did to the business momentum was pretty real. So while they delivered 4% growth in earnings in the supermarket business, we think there's much more to come in that space. And so, the trading at the beginning of the year has been quite positive as you've gone back to more normal conditions. And I think, the difference between us and the market is the market's view is that competition is very, very intense at the moment. There's potential for Coles and Amazon to enter. What we're seeing is that now Coles is independently listed. Almost all of their cash is spoken for through dividends and capex. We see actually a really rational market. And, you think about Woolworths, their margins have gone from 8% to just below 5%. So they've taken them down a long way. It's quite competitive, and all you need now to do is grow the top line at 3 to 4%, get some operating leverage, and you're going to be talking about mid-single digit growth for quite a while now. And with a good balance sheet, they've just announced a $1.7 billion off-market buyback. We think the stock is well placed despite the disappointing result. Another one that was surprising on the upside this time was Clydesdale Bank, especially compared to expectations, because the stock has been dealt with quite harshly by the market, both on the back of Brexit and also the acquisition of Virgin Money. But they did deliver a good result, and you saw the stock, I think on the day, was up 15 to 20%. Yeah. When we think about Clydesdale, we see a really strong management team. They've hit almost all targets they've set for themselves under David Duffy, and they're really controlling costs well. The stock's now trading on around 0.7 times tangible asset value, If you can look out 3 years, which we do, we see them generating an 11% or more return on tangible equity. In developed market economies, banks that deliver 11% plus will trade at a premium to book. So you're at 0.7 at the moment, getting to one times or plus book value, there's some significant upside there. Now, if you're anything like me, every time I read a Brexit headline, I shake my head and I cringe as a Clydesdale shareholder, but at the end of the day, this will be resolved one way or another, and we do think that banking is a core service that the UK people need, and Clydesdale is well placed both in terms of its valuation and execution.
Okay, switching gears from the UK there, like a big part of what we do is getting on the ground, doing the fundamental research and kicking the tyres, not just here in Australia, but going internationally as well. And you've just come back from both the US and China. What were one or two of the key insights you had from your research trip on the ground?
Yeah, so when reporting season finishes, we get out on the road a lot. If you just think about the last month and a half, we've been to the US twice, Asia twice, we've been to Europe and all around Australia as well, so been a very, very active period. When I was in the US, there were two really key takeaways for me. The first is meeting some of the US oil and gas producers who do tight oil or shale oil. Huge change in sentiment and direction from those players over the last 3 years. Previously, if they made $100, they'd go and spend $110, $120 on producing more oil. Last year they went to more spending. If you make $100, spend $100. Today, the market's asking for dividends, and what we're seeing is much more discipline. So while I think you'll continue to see growth from US unconventional, I think it's going to be much lower than market participants believe at the moment. I guess the corollary of that is that we're seeing increasing capital being allocated to international markets. And so really that's the new growth driver, and we're seeing mid to high single digit growth in CapEx in international markets, and that bodes pretty well for Worley Parsons. The second thing that really struck me was plastics. I went to a petrochemical conference in San Antonio, and this was the issue of the day. Every CEO of multi-billion dollar companies was talking about plastics. And to just frame up the problem here, there's 300 million tonnes of plastics produced each year. 8 million tonnes of that ends up in the ocean.
Wow.
If you think about that 8 million tonnes, 90% of it comes from 10 rivers, and 8 out of those 10 rivers are in Asia. So we've basically got an issue where there's too much plastics entering the marine space. The implications for industry have been so far that plastic bags, plastic straws and other single-use plastics have been banned, and I think the industry agrees that this has been a great move. Even in the US, Kroger's have recently banned plastic bags, so plastic bags have pretty much been banned everywhere.
Taking that single use out of the market.
Exactly. But the social issue around this is that all plastics have sort of been thrown into the mix, and so in the UK, I think it's something like 68% of people believe that all plastics should be banned.
Wow.
That would have some serious implications both environmentally and economically, and we believe that would not be to the benefit of anyone, to be honest. You take a cucumber as an example, wrapped in a thin plastic. Now I've typically not liked those when I see those in my house, but as it was explained to me, a cucumber wrapped in a thin plastic film will last 14 days, unwrapped will last 3 days. You think about making 4 times as many cucumbers, extra logistics costs, all the things that happen throughout the supply chain. Banning all plastics is not the answer. And so, my very strong personal opinion is that this is a waste management issue. And so if we put down capital and actually got recycling happening, municipal waste collection happening in some of these Asian countries, this would solve a lot of the problem. And so the industry's got to grapple with this, and they're starting to engage more, but plastics is definitely something to watch because the social issue is growing. Yeah,
okay. And sort of thinking about that issue back home here in Australia and in the Australian market, what are some companies you think could benefit from this shift in towards recycling plastic and the like?
Recycling is a big space, and we're starting to see, the challenge for recycling has always been the economics don't support it. Right now in New South Wales, with the way landfill levies are and gate fees, recycling is economic, and so we've got a position in Cleanaway, and they are spending more and more money wisely, but in that recycling space, because there are very good economics from avoiding putting that in landfill. Another one would be Sims Metal, recycling experts, predominantly in metals, but their skill set is quite broad, and so we look forward to seeing how both of these companies can really take advantage of some of the opportunities that are going to come up out of this whole space.
Great. Well, Blake, thanks for joining us today, and thank you for joining us for the first quarter update with Firetrail, and thanks again for all your support.
Thanks.